Welcome. Today's presentation is Supply Chain 2022, exploring key market variables and what your organization can do to manage in the new normal. And I'm hoping it isn't really the new normal, but it obviously has shown severe weaknesses in our supply chain system. My company is a manufacturer, so we definitely have been affected in numerous ways, from obtaining materials and stuff from China, as well as the trucking and getting stuff off the containers. The speakers today are Amy, Julian, and Tim. And excuse me if I butcher this.
It's Sevcik.
Sevcik. Okay.
See you silent.
Good. From Armanino LLP, and I'll let them give a little bit more on their background. So take it away, Amy.
Awesome, thank you. So just to make sure, can you guys see the full slide here? Or are you seeing my speaker notes?
Yes, I can see it.
Okay, sounds good, thank you. And if anybody, please raise your hand, let us know if audio is not coming through very well or if something's not clicking through and it seems like it should. And then I think, as we mentioned, if you've got questions, please put them in the chat. Tim and I will kind of be monitoring while we go through this. If we can address them during the presentation, we will. Otherwise, we'll have more of an open forum at the end. All right, so a couple of quick introductions. So I'm Amy Julian. I actually worked in procurement at AB InBev for about 12 years before making the jump to consulting. So I've got really deep expertise in procurement, really thinking how to optimize relationships with third parties, but also planning and forecasting, particularly on the demand side. So I brought that with me into consulting and have been working with different clients for several years now. Initially through Brown Smith Wallace, and then we joined Armanino late summer this year. A lot of our clients are a lot more interested in supply chain than they were pre-pandemic. Just wished it weren't the pandemic that actually sparked this interest, but I do believe that there's a lot of power in really strong and agile supply chains to bring additional value to the business. So excited to talk to you guys today. Tim?
Hello, my name's Tim Sevcik. I spent 27 years at Anheuser-Busch before I retired there. Focused in budgeting, planning, financial analysis, forecasting, as well as managing the cost accounting group, the general accounting and the reporting groups. Also did some system implementation. After retirement, my ex-boss from AB brought me into an innovative program he was developing at Brown Smith Wallace. We were developing a rapid assessment process for some Brown Smith Wallace clients where we would dig in, analyze a situation and bring them improvement opportunities, as well as repair some of the broken parts in some processes. Found it some of the most rewarding work of my career. Brown Smith Wallace merged with Armanino this August, and it's opened up a whole new realm of opportunities for us, which I also enjoy. So thanks for having us here today.
Oh. So as you guys kind of heard in the introduction, we'll talk about supply chain looking into 2022. We'll try to narrow in on kind of three big variables. There's a lot going on in supply chain, but we'll talk through product shortages and lead time, labor, commodity pricing, and then think through how do we prepare for the future? Like, what are the opportunities that an individual organization can do and then how to get started. Tim, you want to kind of take us through this slide?
Yeah. So this slide, I'm not going to read it to you, but basically it's a whole new game, right? And prior to 2020, really starting in 2019 with some tariffs, the whole game changed for a lot of people. And first it was tariffs, then COVID. And so it changed the whole scope of how business was conducted. Just in time became much more difficult. Certain safety stock became different, and it's really changed the whole environment of business.
Now, when we look to the future too, we were talking about like what is normal. I think you kind of alluded to it, Jeff, in the pre-discussion. Nobody really knows what the new normal is. I'd actually like to think that this is kind of the pivotal moment that we could say, hey, how do we get out of the supply chain of the past, which was based on, some consistency in what was happening. You had a fairly good point of view of like what might happen, and any changes you could kind of get around, adapt through different band-aids. So as we look to the future, I think it is whatever the new normal is, let's take the opportunity and make it the most of what we can. All right. So let's take a deep dive. This will be mostly conversational. The content is fairly light, but again, please ask questions in the chat if you've got anything going on. I will be monitoring those throughout. Thank you. All right. So product shortages. We really unwind some of what caused the product shortage. We can actually go all the way back to early 2022 when the pandemic started to hit. So as things started to shut down, a lot of companies assumed, rightly so, that demand would be pretty significantly reduced. And we really had no idea what that future was going to look like. That did happen, but not exactly in the way that we expected. Demand for certain pieces of items or certain goods, went sky high, even during those couple of months where we were in a really low state. PPE was one of the major ones, and some of that resulted in containers being shipped to different locations with PPE coming out of Asia that wouldn't have normally been a trade route for them. Then as you started to see the demand come back, it was a shift away from services because many countries were still on kind of lockdown and into that hard goods and spending factor. So that tidal wave of demand that was coming through wasn't something that a lot of companies were fully prepared for. Remember, we talked to one executive in the food industry pretty early on just to kind of see how are you doing? What are you seeing in the industry? And just we've had the worst month ever, followed by the best month ever, to a degree of 2 times better than normal, followed by the second best month ever. But our, the product that we are making has shifted significantly. Instead of making stuff for restaurants, we are now making stuff for people to make bread at home. So they were just trying to keep up the shift in demand and trying to adjust to what was happening. So as everything was unfolding, the production and shipping into the US really started to skyrocket. If you look at container ships, which if you guys are in manufacturing, you've probably seen this, but early 2021, container ship was about $5,000. During the peak this year, it was 3 to 4 times that rate. It is coming down based on the data that we were looking at before this meeting, but it's still not back to normal. And again, some of that's caused by the shift in containers not being where they needed to be at the right time. So just no ability to ship out, but also just by the sheer volume of stuff coming into the different ports. So those port backlogs were huge. Some of the recent changes in policy to work 24/7 have started to divert that. A lot of other ports were seeing help there. But even once you got things off the ship, the trucker shortage that was in existence really pre-pandemic and probably made worse by many of the pandemic furloughs was still an issue. So things weren't getting picked up, containers were getting dropped and not unloaded timely, and an empty containers didn't have a way to go back. So it's really exacerbated the entire supply chain issue. We know we've heard from a number of different clients, over the summer, they were calling, asking, how do we help address this? What are other people doing? And they were having to pay the rates, looking at air shipment, all sorts of different ways to kind of get around it, being very creative. And then they were really looking at how do we bring in more demand, especially for some of the more seasonal businesses. They were actively thinking how to get ahead of their demand and when they had to bring in a little bit more. So that's kind of the history. Where are we today? So we know that a lot of companies did stockpile in anticipation of the holiday season. So when you look at some of the inventory numbers, in the different economic reports, inventory positions are back up. Some of the major retailers did feel like they were well positioned to get through the holiday season with maybe a few pockets of unavailability for different things. On the transaction side, so global transaction companies have shown that they do see a dip in purchase orders and invoices, which mean fewer new orders are flowing into the system. So hopefully starting to work through that backlog and not being made worse as we go into 2022. A lot of investment was starting to get made. So CapEx investment saw an uptick. So I think manufacturing is also expanding in a number of different areas. But we have to be careful here because even though it might be getting better kind of today, and it looks like there's some hope, still highly open to disruption from Omicron or whatever is out there, as well as this is still off a base that really doesn't compare to pre-pandemic numbers. So when we look at what analysts are saying, was looking at anything between, hey, Q2, we should be back to normal kind of after that Chinese New Year's, with Asia being kind of a pinch point for some of these decisions, potentially all the way to Q4. So just a lot of fragility still in the supply chain. It's going to take a while to get back to normal on this. One client story I'll share. So we had a hard good importer. They were a heavily seasonal business. When the shutdown started to happen, demand for their product completely dropped. Their product was used in kind of a service market. So it really didn't have a place when everybody was staying home. They had to go through the furloughs, manage their cash flow really tightly. I think they were seriously worried about their ability to survive. When things started to pick back up, they, like many other people, saw a huge peak in demand, and they weren't able to keep up with it. So I think all year, I mean, really since people started coming back from some of the social distancing, they've been just trying to keep up with demand. And then ahead of the very busy seasonal peak season, which was kind of the worst of the port and transportation backlogs, they have been managing day to day, putting new plans in place to get containers in, using air freight a lot for high demand products, and really running daily analysis based on what they're getting unloaded in their warehouse. Tim, did you want to share an example too from one of your clients? Tim?
Sorry, my headset broke, so I'm having to mute and unmute. We were working with a client who relied heavily on some raw materials coming out of China. And when the tariffs began, they made a strategic decision that they were going to spread their supply and use a domestic supplier as well, even though that domestic supplier came at about a 20% price premium. Our particular project was to help them with the costing so that there were no incentives for people to use the lower cost supply, that basically share the cost of a weighted average cost from all the suppliers. But basically they made a decision 2019 to spread out their supply chain well in advance of COVID. And that was one of those circumstances that turned out very nice for them, obviously, because as a disruption came, they had another supplier. Otherwise, they would have had significant supply problems. So what that means is, think about in the past, there was such a focus on low cost and a focus on just in time. And maybe when the supply chain is impacted like this and more volatile, you need an insurance policy, right? You need that upcharge to them was really their insurance policy to ensure supply and the ability to still sell.
Hey, Tim, I've got a question about manufacturing moving back to North America. And I think that's where that example starts to come into play. I mean, even before COVID, depending on industry and kind of the profile of the company itself, sounded like they made that decision even pre-pandemic.
Yeah, when the tariffs were coming into place with China, they were really having trouble knowing. They did not know how far the tariffs would go, and they just felt like it was a very good decision to spread out their suppliers. But the tariffs was really the driver that said we need to do something.
And I will say we've got clients on both ends of the spectrum who are looking at moving manufacturing back to the US to kind of mitigate that risk, as well as clients who are moving it offshore to really capture those cost savings if they felt like it was still worth that risk, and that they're taking different approach to how they plan to kind of adjust for that. So highly variable, somewhat dependent on your specific organization's needs.
And the other part of that we'll talk a little bit more about later, moving your supply closer to your production facilities, it does support the green environment, right? Because you're doing a lot less movement and consumption of fuel along the way. So in some cases, it also supports, the green environment that many people are looking for. Should we move on to labor, Amy?
Yep, sounds good.
Okay, so we were rolling along very nicely as a society, as an economy, and then came COVID. A lot of health concerns from people. Do I want to keep working? They started working from home. Many people liked it. Some people didn't like it. Mixed reviews on the companies. Then COVID relief payments started coming in. In some cases, people could make more with their COVID relief or with some of their unemployment than they could with going back into the workforce. So the shortage of labor really started accentuating rising wages, as it should. Then strong financial markets came along, continued strong financial markets over the last several years. A lot of people got to early retirement age sooner than they expected, okay? So all the while, we've got this work-life balance that people are trying to work, and it's becoming even more difficult to have the work-life balance because you have school closures and you have just trying to manage the household in a time when things aren't as easy because of COVID shutdowns. So a lot of things changed. And the thing that really woke me up to the degree of the changes is when my daughter was telling me about her work coming home from college this year. She's doing retail this year, which really surprised me because she was always a restaurant person and got very good tips. But what she has found is that since there are fewer people going to the restaurants, the people that come in temporary get less tips because there's so much more carry out. So she found that it's more advantageous with the increase in payments on retail to work in a retail store. There's a couple of other stories about just restaurants in general. One person I know, they work for a small family restaurant. The family actually gave them an ownership in the restaurant, 5% ownership to a couple of the key employees. Another restaurant has stopped the split shifts, and they're basically letting their students study during slow times that maybe they used to be split shifts. So a lot of creativity is going into the labor market right now in how to retain people, how to improve their work-life balance. And there's also the Amazon warehouses. You know, they've implemented a process where they can fill positions, but the people can choose their shifts in advance. Again, helping. Typically, there was a lot of telling employees what they were needed to do when, and it's a shift to support work-life balance and retain employees, being able to choose when you want to work and just meet your quotas.
And just a couple of data points for you guys too. So 42% of business owners reported raising compensation. That's actually a record high, according to the Economic Impact Report. We've also been looking at some attrition metrics. So you guys have heard the Great Resignation. That is showing exactly how difficult it is to retain employees. And as you're looking at partnering, that could be a key indicator of upcoming cost increases if you've got a high attrition rate, especially all the way down your supply chain. That being said, we do know that some recent data shows that workers seem to be coming into the labor force. So total labor force participation rates are the highest they've been since the start of the pandemic. So not necessarily pre-pandemic, but I think with some of the government programs starting to roll off, starting to change, that does seem to be improving as well. One of our bigger clients as well had a warehouse locally where they had been struggling to get people in, and pre-pandemic. I think this shows like the pandemic really just exacerbated a lot of the issues that were already there. But they had struggled to keep workers, and they struggled to bring in new workers, and they were seeing a huge cost related to having some of their executive team have to go out there and help with warehousing and the constant need for training. So they took a really hard look at what the market is, where their workforce was going if they didn't stick around. They ended up raising their hourly rates from about $4 an hour. So they were kind of under the acceptable market rate, and they went slightly over. It was a huge impact to them, but I think ultimately they're hoping that the long-term cost of that weighs out, and then they're also looking at pricing increases related to all of the pricing changes that have happened this year. All right, so I think kind of coming from labor to commodity pricing. So ultimately, labor is a commodity. So that is going to go into the pricing point for anything that you use in your organization, as well as potentially your organization itself. So commodity is just anything where a situation where the end product price is set based on the main ingredients. So it can cover a lot of different pieces, but labor is one of those key things. So the ability to retain labor, the cost of that labor is going to increase commodity rates across the board. So then when you think about the trade war, tariffs and trade restrictions, it's kind of on pause, don't really know what's going to happen. I mean, even Biden has been talking a bit tough, and I think he's actually got an upcoming summit with China on how to go forward with this. Those pricing points that were passed along for the tariffs that were in place are still often existing. So they're trying to figure out what that's going to look like, some of the downstream impact of that. We saw shifting of supply out of China into Taiwan, into other countries, and that seems to be continuing along that path because of the uncertainty in that relationship. Additionally, domestic supply of key commodity has been limited due to regulations, curtailment. Sometimes the impacts that these regulations were intended to address don't fully impact the cost structure. So having to bear that additional cost increase has been really tough. Then consumer demand, ultimately in a commodity market, it is the matchup of supply and demand. So as demand continues to go up, it is fueling downstream supply impacts across the board. Tim, anything that you wanted to add on commodity pricing? Otherwise, I'll jump into a little bit of data on some of these metrics. You're on mute again.
Go ahead, let's continue.
Cool. All right, so when we look at where commodity prices are, the producer price index, which is essentially kind of a basket of goods, we used to bake these into contracts with some parameters about how that would impact the cost to bring in those products. I was shocked when I was looking at this, kind of preparing for this. So that annual rate of 8.6%, it's the largest since the inception of the index. That's huge. You do see it starting to trend down kind of in the later half of 2021. So hopefully that does continue as stuff starts to free up. Maybe there's some ability to kind of go back to a pre-pandemic way of life. And I do think that there's real possibility that some of the consumer demand for goods that was driving this starts to even out as we get through the next round of COVID, as we start using more services and start to get back to something that might be a little bit more normal. We also took a look at some commodity prices below this as well. So when we look at West Texas Intermediate crude, the Energy Information Administration is estimating that will go up again in 2022. They're thinking it could be as high as $68 per barrel, up from $39 per barrel in 2021. Natural gas has also been a really hot topic, so that could end up steady to slightly down compared to 2021. But looking back to 2020, it's still roughly double what it was pre-pandemic. And then I think this could potentially impact how consumers choose to do things or to buy things. And Tim can talk a little bit about that. Tim?
There's that button again. Okay. So yeah, one of the things that will happen during inflation is there tends to be a moving to cheaper goods and services. For example, I did some numbers of a family that has a good steak and good fish each twice a week can fully offset a 20% price increase just by cutting back one fish meal and one steak meal a week and substituting chicken or pork, right? So the thing that's going to happen during inflation, thing that happens is people look at their discretionary spending and try to readjust it because there's a limited supply of either debt or income, right? Sorry. Yeah, so the thing that we need to look at is how is that going to impact our business, right? Because if we're having inflation and there's less spending dollars available, how are they going to spend it? You may achieve the same volumes, but you may have a quite different mix. We saw that frequently in the beer business. When gas prices would go up, there was a market change in our mix, because the people that would go to the gas station with so much money in their pocket and fill up with a tank of gas and buy a 6-pack of beer, they would have less money. Gas would consume more money, and so they'd have less for their beer. And that's something that we need to watch very closely as we go forward in this inflationary environment. So it's not just the inflationary input cost to you, it's also what is the impact on your demand from your consumer base.
Yeah, and I thought we had one example come up from our clients where they took a pretty extreme approach for how they wanted to manage the risk around increasing costs. So they're a distribution company. They use quite a few trucks, a lot of gas. They have their own fleet that they use. They had a lot of land. So just to kind of set the stage, when they were looking really much earlier in the year about what the projection looked like for the fuel industry, what their exposure could be in terms of gas and different cost increases, they made the decision to actually pre-purchase quite a bit of gasoline for their trucks. So they knew that there could be a downside risk to that, but it was essentially a hedging strategy that they felt like they could take and that they didn't want to bear the risk. They had the ability to store it on site. So they went ahead and executed the plan. They've now got quite a bit of gas for the next year, but they felt like that would help them understand their own cost structure and pass that along to their consumers in the best way possible. So again, seeing a lot of creativity on how people are choosing to manage the risk around increasing cost, and we'll definitely see. So Willard asked, forecast on heating expense this winter and its effect on consumer demand of other prices. So that's where that natural gas spot could come into play. So we do expect that to potentially hold steady compared to 2021. So I think kind of as Tim was talking, in and of itself, at least in the US market, we don't think it's going to be a significant impact of consumer demand as long as it's similar to last year. What could come into play, though, is as some of the government intervention programs are coming offline and people have less cash in their pocket. If labor rates aren't keeping up with inflation, then people are going to start to make different demand decisions and potentially trade down of what they are purchasing. So kind of underlying all of 2022, when Tim and I were talking before this call too, I think we're a little bit cautious about how strong that demand is. We know that the growth number for the US actually came down a point as well, still growing pretty strongly. But I think there's real possibility that as we are in somewhat of an inflationary and highly volatile environment, still very uncertain of how that impacts labor rates, especially as more people do start to come back into the labor market. You know, be a little bit cautious in how you plan, because there's still a lot of unknowns that are out there. And if we learned anything from COVID, it's that the last 12 months does not necessarily mean that the next 12 months will look a lot like that.
And maybe the other comment about the labor rates keeping up with inflation. There's also a segment of the population that's retired is becoming an increasingly greater group, right? And they tend to be, some of them tend to be fixed income, which means they're not going to get the same offset that some of those participating in the workforce will be getting. Again, they won't be getting the same earnings increases.
Yep. Yeah, and now I was also looking at, you know, the labor, who is actually leaving the labor market. A lot of the people that were part of the Great Resignation were kind of mid-career. So I found that really interesting. Like, although a lot of people have been potentially retiring early as the economy has been doing well, a lot of people who were leaving were in the middle of their careers. And whether that's a shift or a break to kind of get through the pandemic pieces, we don't really know yet. So I think that would be very interesting to see as that pans out, how that comes to be. All right, so let's think about kind of the future piece of this. So these factors that we looked at back here, they're macroeconomic. There's nothing a single organization can really do to significantly impact these. They're based on kind of consumer demand, the availability of supply. It knows they're very tied into, you know, government programs, tariffs, the way that people are shutting down manufacturing sites, both in the US as well as overseas. So they're highly interrelated. But we do think that there are things that an individual organization can do to prepare. And a lot of that's around kind of creating that agility, kind of creating that view around the corner, if you will, about what potentially could be coming up. So if we think about the first one, build a scenario planner, probably a lot of you guys built that when you were going through COVID, maybe especially around the cash flow part. But when the market was more constant, it was easier to build a plan and model. A lot of the models that we saw kind of at the different clients that we were out at were pretty limited, and they didn't fully account for those disruptions that the scale of COVID had. If, some of our clients had a pretty decent supply chain risk assessment where they knew, you know, if there was a natural disaster at one critical supplier, here was kind of what the plan would look like as they built it downstream. But the scale of COVID and the pandemic was something that hadn't been built into the plan. So really thinking about that on a very different level has become a key focus area.
And Amy, as we look at some of our smaller clients, a lot of them are not strong from a planning perspective, especially some of the family businesses. Some do not even have a plan. Okay, so if you're relying on a supplier who's a small family business, it'd really be worth your while as part of your planning process to understand where they are if their product could be at risk. But you know, the budget, like you said, Amy, the budgeting process, the planning process used to be a lot easier. I think we need a lot more scenarios here, not just in managing the cost and who are our suppliers, but also taking a hard look at what disruptions may occur and how does that influence my ability to sell to the customer, right? Are you going to have shortages that limit what you can sell? If you're going to have limitations on what you can sell, what is your strategy going to be? Are you going to take care of a group of customers? Are you going to sell to the highest bidder? Those things all need to be thought through so that if the time comes, you're ready to go.
And we've got a question in here about how do companies build their 2022 plans given the uncertainty for inventory levels? Multiple plans is one of the key ways to do that. Have, you know, kind of a different scenario to make assumptions based on what the markets do, and have an action plan for all of those different risks that are out there. That's
go ahead.
Yeah. I mean, that there's a lot of really amazing kind of tools, and we'll talk about technology that can help do that a lot more efficiently. But as Tim was saying, really thinking through who are your core customers, what's the pricing impact, what happens if you don't have enough inventory, how much inventory do you need, are all going to be kind of key questions that you want to be able to model out a lot more efficiently than maybe we were doing in the past.
Yeah, and the problem with Excel is it's a great one scenario plan builder, but as you get more and more variables involved, it becomes increasingly difficult to manage all of those. So the first thing to keep in mind is keep it at a high enough level to where it's significant, and try to weed out anything that can be stable or is immaterial, right? But from the scenario standpoint, it needs to be built around what is going to vary and what are the risks involved. So you're going to have probably a wider range of volume assumptions involved. You'll have wider range of pricing assumptions, and you'll have a wider range of input costs. And there's a couple ways to manage that. We're going to talk about some planning software that Armanino uses with its clients in a little bit. There's also a tool that I've used in the past called At Risk, which is a Monte Carlo simulation, and it sits on top of Excel. And instead of saying my sales are going to be $100,000, you could say my sales are going to be, my sales volume is 100,000 units, but the low might be 80,000 and the high might be 110,000. You do the same thing with your sales prices and your costs. And it kind of then shows you a distribution as what is the likelihood of certain outcomes. If you're cash strapped, something like that is very valuable, because in some of the bad situations, your business can be at risk.
With that scenario planner, if you're able to build in leading indicators, so look at the market, say, hey, what are those things that can give me early indication of whether the strategy or the market itself is changing? because of the uncertainty, the different disruptions that may not even be known at this point in time, being able to react quickly is really the key here. So as things start to change, can you shift? Can you do something different? Which kind of leaves us into the improve operational flexibility. So in terms of inventory, a lot of clients are asking, like, how much inventory should we take? Should we move away from the just-in-time model? Just-in-time is incredibly powerful. So especially for a manufacturing environment, it does kind of keep inventory slow. It makes it all work. But because a lot of those supply chains are so globally based, it is prone to disruption more. So what we've been recommending is really look at your components or the goods, take a look at their overall life cycle, how long, how many different products are they used in, and make kind of product by product decisions of how much you want to bring in. Along with this, and it kind of relates to the should cost model and pricing strategy, really understand your margins for different products. How likely are you to kind of maximize that margin? How much room do you have to discount if demand for that doesn't come through as expected? So that operational flexibility in terms of inventory is key, but also in terms of like manufacturing, or if you're a service-based industry, how do you reallocate resources to be able to do something different? I don't think that we are particularly good at kind of developing broad capabilities amongst our people. I know in consulting world, we've made a concerted effort to make sure that people had kind of a baseline skill set so that we could shift resources to other groups depending on the need coming in the door. Different manufacturing sites are doing some of the same things. So how do you make it easier to shift between different key product lines? And what would that look like in terms of automation, your footprint on the manufacturing floor, and really think about how to maximize that.
Another part,
go ahead, Tim.
another part of the operational flexibility, it occurred fairly early in my career at Anheuser-Busch. They were buying a lot of grain on the open market. It was a competitive market, and it was a very volatile market. As agricultural commodities prices vary considerably with supply and demand, and you have variability in the crops, and so that was causing a lot of spikes in pricing. They made a strategic decision to have an insurance policy, and they invested in a grower infrastructure. Basically, they decided they're going to try to cut out the middleman for a percentage of their grain requirements. And so they invested in grain elevators that would work with the growers and basically contract with the growers and supply grain to the beer company. And they also chose to move some of the supply to the west, where they had irrigated ground, which gave a more consistent yield year in, year out, cutting more of the market volatility. And they worked with growers, just building relationships to make the growers proud to be supplying barley to that company. The impact of that was incredible, because something that would go up and down, some years 50 to 75% in price, went for about 5 years very flat. Okay, now there was a known cost of working capital carrying that year in, year out, but the smoothness of your supply and the need to not have to buy when prices are up and buy when prices are down gave them a very good advantage. The other thing it did is it gave them insight into the particular grain markets. So as Amy mentioned, leading indicators. So in talking with the growers day in, day out, they could clearly see where the markets were headed based on just seeing these fields and how they were performing throughout the growing process. So that's one thing. That was a very big strategic move that helped them manage their supply chain.
So then we talk about technology a little bit. So there's actually kind of 3 areas of technology that I think are worth taking a look at. First of all, data shows that CapEx investment is expected to increase through 2021. We're already seeing some of that and remain high through 2022. Some of that's driven again by market rates. So that could change as the Fed decides to increase their overall rates. But there's kind of shop floor technology. So what in terms of manufacturing automation, warehouse automation, WMS, different picking technologies that could really improve that operational flexibility that was above. We've seen costs, really start to fall on some of these technologies, and it would expect that to continue in the future. And that would also potentially address some of the labor rate shortages. So one of those distribution companies we were working with, while they made some short-term decisions on how to address their labor, they're also looking at longer-term investments and how to modernize their facility so that they're not as exposed to that in the future. On the kind of scenario planning side, there's some really cool tools out there, and I'll let Tim talk about some of what those look like.
Here we go again. Okay, on the technology side, we've got robotic process engine automation, which is automating manual tasks. A lot of companies are also going with dashboards, which helps identify those leading indicators we talked about earlier. There's warehouse management systems, transportation management systems. We talked about planning and scenarios. There's an adaptive planning program that's the program that Armanino works with some of its clients and implementing. Does a very nice job in managing the different scenarios. Warehouse automation, the software will go a long way toward both standardizing as well as reducing your costs and introducing consistency.
Yeah, and I'd say that where we've seen a couple of different companies really be successful with kind of these bolt-on applications is if they have an existing ERP that might be highly configured or really challenging to get out of. So those are kind of ways, maybe as a shorter term fix. It's not terribly expensive and certainly much, much cheaper than investing in an ERP. But also, ERPs have come a long way. We saw clients working in blue screen technology in some cases and figuring out how to get them out of this legacy ERP that's not very adaptable to the agile environment that's needed has been a challenge for a lot of different companies.
Amy, I always chuckle when you talk about the different technologies, because one of our clients, as you mentioned, we were in there and they basically had, remember the old CRT terminals with the green screens and the etched in, you could see the outline of the key digits and where they usually apply, but we still see some of that. Okay, now they had better monitors than we had 25 years ago, but it's amazing the breadth of the technologies and what people are using. So sometimes if you have we found when people have a lot of manual processes, get a look at your technology and your technology strategy, and that can really uncover some significant opportunities for you from an overall cost standpoint.
So the last piece of technology that I think is worth discussing is really how to get on some of those leading indicators. So more on the sales side than on the supply chain, but there's a lot that can be done in terms of tracking opportunities for different sales, depending on if you're, really have to operate with different clients for major equipment sales, services sales. If you're direct to consumer and selling, or maybe even a B2B, but you've got kind of an online portal, making sure that it's a good user experience, that it is something that's highly engaging, and tracking those metrics all can be kind of brought back into that scenario planner as those leading indicators to say, hey, what's going on? Where are we being successful and where are we not being successful? So moving over to kind of developing the should cost model and update pricing strategy. So really understanding all of the costs that go into your product or service. If it's a service, it tends to be a little bit more straightforward. You're highly reliant on labor rates, but potentially also the technology that you're using to enable that service. On the manufacturing or consumer product side, mapping your supply chain all the way back to see kind of what are those commodities that impact your component goods, that then impact your end product, and understanding what that cost should look like can be incredibly powerful. That's going to help you understand your margins or what those margins should be, and have those candid conversations with the suppliers about, what is the right price for this and how do you pass that on. Pricing strategy has been a huge discussion point for many of our clients. I think it was one of the questions in the chat as well. Across the board, everybody is looking at pricing. If they've got any sort of goods coming from China, experiencing those high transportation rates, not just China, anywhere non-US based. And in the US based, the pressure on labor rates is taking that up as well. So everybody is looking at pricing. Everybody is trying to decide, how much to take this up. I have heard only success stories, and I think it's been kind of a slow increase. I know when the tariffs were put back in 2019, pre-pandemic, it wasn't a full pass-through. It was oftentimes kind of an 80 to 60% pass-through. Those have been maintained. And any pricing increases that have been out there so far have been pretty successful. Where we are hearing a little bit less of a success story is kind of those smaller businesses that are operating kind of front lines directly with the consumer, where they're getting the price increases from their goods manufacturer that they're selling through in the stores, and they're getting squeezed on their margin that they could pass through because they can't mark it up any higher. So I think that's where the risk is. Related to that, I think that the bankruptcies and kind of the PPP loan keeping people through, we haven't seen a ton of bankruptcies, although to be honest, it wasn't a data point that I was looking up ahead of time. But there is risk, I think, as we go into 2022. Some of that support from the government is expiring. You're going to see these pricing pushes and potentially margin getting squeezed on especially small businesses would be the risk area there. Tim, what have you seen as far as pricing from some of your clients?
Yeah, from a pricing standpoint, one of our clients was in the baking industry, and they did tremendous this year. They had more business than they could do. Their price, they passed along basically the inflation pricing on it. Another client is more involved in supplying utilities. They're having a tougher time on the pricing because the larger utility companies it's still a very competitive environment. So their ability to pass along price increases is quite limited. Okay. The company I talked about, which made the change in its supply mix using a domestic supplier, they did quite well. So what their strategy was, I'm going to take care of my core customers, and I'm going to then sell to the highest bidder for those who are not part of what I would consider core. So a lot of different scenarios to go at there. It comes down a lot to your vision and how you think you want to come through this, and how can you use this variability to come out at a stronger company and maybe better aligned with your customers, right? As well as understanding your supplier base, and maybe you have suppliers that are not really aligned with you that you can substitute for someone more interested in you and your company, right? So
I will
that's a short answer.
Yeah, and we do have a couple of data points to share as well. So research is showing that they expect disposable income to fall in 2022 as compared to 2021. So there may be a decrease in demand. There's also about 46% of small business owners reporting raising selling prices, with wholesalers kind of being the leader. So that is expected to continue. So prices are increasing, but potentially disposable income is potentially decreasing. So we do expect to see some shifting demand patterns when we look into next year. So the last piece of this is really shoring up the supply chain. So those partnerships with suppliers who can address your supply chain risk. I think we've talked about this throughout the conversation, but really working very closely with your core suppliers. What we heard a lot of really during the pandemic, and we're continuing to hear this, is really reevaluating your supply chain approach. So prior to COVID, single source, maybe dual source, but frequently like really deep partnerships with a couple of key suppliers. Through COVID, we do see a lot of interest in diversifying. So how can you work with different suppliers? Does that require investing with different suppliers who maybe don't have exactly what you need, but could be a partner in the future? So figuring out how to diversify that supply base has been a key interest area. There was one client we worked with, they'd been vertically integrated. So they were a processing company. They had a farm that was the major input, but they were growing a ton. So they actually wanted to go out and find partner farms to work with them to send them their product and be able to process this significantly. They went through quite a program to figure out, what are the appropriate contract terms? How do we incentivize them appropriately to sell just us, because it was a highly commodity market? And then how do we tie that back to some of the commodity pricing so that we are clear that we're offering them the best value and really creating that partnership for the long term. Another thing we did with a different supply base was we had, like in pre-pandemic actually, but there was a supplier who was trying to take up their prices significantly, and they were a major supplier. The decision was made at a high level strategic point to really develop another supplier in the base industry. That required actually helping them with some of their cash flows. So taking their payment terms down just so that they had enough cash flow to do those operations, and then lending them some resources to help them figure out how to meet the specifications that we were putting forth as well. It ultimately paid a ton of dividends over the long-term relationship with that supplier, who became a major player in that particular industry. And then the last one, again, you can tell where my kind of background is on the supply chain side, but really working with different suppliers to create some innovation. And ESG is also something that we're trying to hear about. So the importance of ESG, both to the consumer in terms of demand and the price that they're willing to pay for it, seems to be going up higher. However, we know that a lot of the supply base has not invested in what they need to have the correct ESG strategies. And that could put, companies at risk as we go forward. So I think that's a critical area. And then just a quick data point here, 68% of organizations are actually actively investing to diversify their supply base, whether that means offshore or onshore. That's a pretty big number compared to what we saw pre-pandemic. Tim, anything else you want to add on the supply chain piece?
No, we're good. And wasn't that a quick draw on the mute this time?
Awesome. All right, let me go to a couple questions. So first of all, Tim, can you put in some of the names for the planning software into the chat room? That would be awesome. And then have a question of, banks have given customers or marginal customers a pass during the past year. Have you seen banks come in and limit funding to these customers? We have not. I think there's still enough liquidity in the market that it really hasn't been an issue. Although we are seeing some early indicators of, more questioning, different PE firms being tighter on their due diligence. That is often who we're working with, is those PE firms. So really understanding what type of investment they're getting into. And we've been asked to come in and really help with that on a couple of operational pieces. So they are much more interested in that supply chain aspect of the future plans for that company that they're potentially buying than they were in the past. So that is a difference that we are seeing. Another question is, are there any success stories for sharing where a company anticipated shocks like 2020 and secured valuable insights from their already implemented scenario planning forecast? I think the one that you were talking about, Tim, is a really strong one as well. Any other kind of already implemented scenario planning pieces you'd want to share, Tim?
I have been working the process improvement side of Armanino far more than the planning side. So while I talked to the gentleman that runs the planning side, I don't have any good examples that I could share at this point. But I'll give him a call and I'll share some examples after the fact via email if everyone's interested, if that answers the question.
Yeah. And then I would say a couple of our clients too, they had really poor kind of planning scenarios. So figuring out where to get that early indicator data from has been a really key piece in the planning process, where they didn't have any insights. They weren't getting feedback from their sales team about what was flowing through. That has been a major difference maker if they're able to get faster data flowing all the way back through.
Yeah, I mean, we just sold us an ERP system to one of our clients, or we helped them purchase. We didn't actually sell it. They had no planning process, and we were trying to sell them in on, you know, something just simple budget to actual process review. When you get smaller family-owned companies, it gets increasingly tougher to do that because of some of the structure. Whereas when you're public and you have responsibilities on reporting outside, it forces you to do certain planning that has to be much more intact.
So how to get started on making some of these changes, if you haven't already, because I think a lot of people are, like that's where we're seeing a lot of interest on our side. So first of all, building the right team. What we've seen be really successful as we think about, you know, the future opportunity is getting a mix of really strong SMEs from the business. They're going to know where all of the skeletons are buried. They're going to know all the pitfalls. They're usually the ones that have to live with any sort of change that you're making of, you know, how you leverage a scenario plan, how fast you have to pivot based on different pieces of it. So they provide a ton of value. With that, though, you do need somebody who can really think kind of future oriented, bring in new ideas, not be constrained by the way things that have been done for the past 10, 20, 30 years that they may have been in the organization. That might be somebody who maybe just isn't as tenured, or sometimes external support as well. The other piece of this is retention and succession. So we've had a couple of clients who had surprise exits, you know, people that they really thought were strong, fully invested, but the market is really hot right now. So making sure that that discussion is open and out there so that you're not losing key players as you build a team to execute some of these projects.
You know, Amy, we had a client, one of our clients, they lost a person mid-level in their accounting group, and they offered that person a lot more money, and the person wanted to work from home. So, you know, again, a lot of it goes back to understanding what these key people need, right?
Yep.
There's
And then,
also-
yeah, go ahead.
There's also a successful client of ours who they let some of their employees go to pick up their kids from school, right? And then they return back, they get the kids back home, and then they return to the office. I mean, the flexibilities. I grew up, my career early was you are in the office, and none of these flexibilities existed at that time. Now it's tough to manage, but it also ensures your supply of employees.
The next one here is assess risk and identify impact. So as we kind of walk through executing a strategic project, a lot of times we find that there's indecision and uncertainty about, you know, what's the next step to take, because there's risk. Like any decision that you're making about changing your strategy, changing your technology, changing your operational footprint, there's going to be risk involved. So really quantifying those risks, what is the potential impact? What is the probability of that coming to fruition? Has been an exercise that has been very beneficial, just so like you feel like you've got the right information to make a decision and move forward with it. So that is something that we've worked with a number of clients on too. And while you can't address all of the risks, at least you've got a clear view of why you're making the decision that you are. Kind of with that, you know, the solid data and strategy behind that, that's probably one of the biggest challenges we hear about right now, is being able to figure out where the data comes from. A lot of companies didn't have maybe a great data governance strategy, so the data itself is dirty, it's not clean, it's not standardized, and so the insights that they can pull out of it are not as great as they would like, or the level of effort to get those insights is pretty significant. So really working with your IT team on how to leverage the information that you already have internal to your organization is huge. And then the flexibility, right? So plan is only so good, and there's a lot of stuff going on in the market right now that is outside of your control. So what are those regular touch points? Does the team have the ability to pivot and say, hey, this is a no-go, you know, something happened that we have to change our strategy and approach, and giving people the outlet for that discussion and to be able to pivot quickly. And then the last piece of it, just proactively monitor. So as these major changes to strategy are being made, figure out how to make sure that it's going well, that that discussion continues so that it doesn't get super far down a path that doesn't no longer works. All
And
right.
one quick comment.
Yeah.
It's important to differentiate data from information, information being meaningful and data being what is transformed into information, right?
Yep.
So that's part of the key to being proactive on this is transforming data into information. And we're at a time where tools like Power Query can do that much more efficiently than anything we've had in the past, where the end user, the accounting analyst can do things like that. Rather than having to get an in-depth IT program or programming to do this.
Yep. So that kind of wraps up. We've got, I think, a couple of minutes. I'd love to hear any questions. I don't know if anybody would like to share some of their own changes and strategies as well.